Hey everybody, this is RC Peck with Fearless Wealth Research, and it's good to have you here. And I have a lot on my mind in regards to the markets because there is a lot going on right now. And in regards to what I want to share with you today, I want to talk about bond yields. And specifically, I want to talk about the three most important bond yields on the planet: the 10-year US bond yield, the German 10-year, and the Japanese 10-year, because there's just some crazy stuff going on. So if you look at the screen here, this is the 10-year US Treasury yield. It is probably the most followed yield on the planet. And I wish that when investment people talked about the bond market, they'd either talk about the bond market or the yield market, because it gets very confusing on what people are talking about. So I'm going to talk about the yield market, meaning what these assets are yielding. And I understand that no one else says the yield market, but that's actually what we're looking at. So this is the 10-year US yield market, and I bracketed it on the top half of the screen, or the top part of the screen. You see that 3% yellow bar, and then at the bottom you see the 1.4%. And then down here, this is a price chart of IVV, the S&P 500 with dividends reinvested. So what I want you to get is this price chart starts at the March 2009 low, when the market had just finished its 58% drop. What I believe you see and what I see here is you have this 10-year yield that has been very erratically moving between 3% and 1.4%. Now I want to point out a couple things. When we were back down here the first time the yield market hit this 1.4-ish percent, if down here, it's hard to see, but what I want to point out to you down here in the lower part of the screen is the S&P 500 had just fallen 20% and broken out to new highs and then come right back down to test that. And when the market came back down after breaking out to new lifetime highs, the 10-year yield in the US, it absolutely fell down to 1.4%. Like, it was literally happening. There was panic going on. And then if we go to 2016, the exact same thing happened when the S&P 500 was breaking out to new lifetime highs after going sideways for 8 to 12 months. It did. Okay, it's hard to see down here, so you're just going to have to follow my words and not necessarily look at the image per se. But again, we had the 10-year yield break down to 1.4. In fact, it broke down below that. And look at what's going on right now. We had a 10-year yield above 3%. It could not sustain itself, and it reversed course. This is called a false breakout, and it absolutely started falling fast. Now look, there's not a lot to stop it until it gets down to the 1.5, 1.3 range, right? So I'm not saying it's going to take an elevator shaft down over a couple days, but the next major, really major support for the 10-year yield is right down in this, what I'm going to call the 1.4 yield area. Now here's what's crazy. The S&P 500 has already broken out to new lifetime highs. Unlike back here in 2016, where the yield was already way down here, and back here in 2012 when it was all down here. The takeaway, the way I see this, is investors do not want to be in the stock market. They are caught up in the noise machine and the panic machine, and they're listening to words and sentences and paragraphs, and they're absolutely scared. And they're pulling money out of the stock market. They're literally pulling money out of the stock market, even though it's breaking out to new lifetime highs. They, quote unquote, don't believe the stock market. They don't believe it. They're super scared, and they're scared because they're listening to people who are scaring them. And here we are with the market breaking out to new lifetime highs. And people, you can see this. People are panicking even faster, even though the market's breaking the stock market. Guys, every time I say the market, just assume I mean the stock market. The stock market, the market's breaking out to new lifetime highs, but the public doesn't care. It doesn't believe it. I think the surprise is the market goes higher for 12 more months. Now, if you've been in my world, you know I don't predict. I didn't predict in '08. Lehman was going to go out of business, the biggest U.S. bankruptcy in U.S. history. I didn't predict the market was going to fall 58%. But what I did tell you was, guys, the signal has been blown, not blown. The signal has been signaled, has been alerted. Get out, get out, get out. And those words of getting out happened at the end of '07 and the beginning of '08, right? I didn't know what was to come. It doesn't matter. You don't need to know how bad the storm is. You just need to know the storm is coming and the clouds are black and they're getting blacker and the storm is here. That's what's so great about Fearless Wealth Research is we can eliminate the noise. We know the difference between a crash and a correction. So I think the surprise is going to be the market going higher, the stock market going higher. And it's going higher with fewer people. All I've seen over the last couple months are headlines of tens of billions of dollars getting pulled from stock market ETFs and stock market mutual funds, and not just in the US, but across the globe. People are pulling their money from the stock market and they're absolutely cramming it into the bond market. And that's why you see the yields falling. And I think it's a mistake. I think it's a mistake. People are worried about this catastrophic storm coming, and yet the sky's blue. The clouds have cleared away. We're getting gorgeous sunsets, right? It's clear skies right now. Now, if this changes, with my research, I will change, right? I'm unattached to the direction of the stock market, as I believe you should be unattached to it too. Of course, we have our biases. Of course, if we're fully in the market, we want it to go higher, but we want it to go higher in a way where we're unattached to it. So we have the 10-year yield, the US yield market absolutely falling very fast. I believe it wants to go down to that 1.4% again and kind of test it and see what's going on. Now, the US yield market doesn't live in a vacuum. So let me show you the German yield market, which is very scary looking. Now, what you see on the screen here is the 10-year German yield. That black horizontal line on the top section of the screen, that black horizontal line, here it is right here, that's the zero mark. Now, the reason why the German 10-year yield is so important is because this 10-year yield really determines the yield in the Eurozone. And the Eurozone is the largest economic bloc on the planet. There is not a larger economic bloc on the planet. The second largest is the US. The third is China. The largest economic bloc on the planet is basically saying, we need negative rates. We need negative rates. We want negative rates. And on the bottom part of the screen is the S&P 500. And you can look at those two, the 10-year German yield and the US stock market with dividends reinvested, and it looks very mirror image-like. That's what I see. And so we have the German 10-year yield right here making new lifetime lows. And at the exact same time, we have the S&P 500 making new lifetime highs. But again, people are not prepared, right? And it's not their fault. I really want you to get this. I understand why people have 3, 4, 5 subscriptions, right? They're looking for the one thing. They're looking for the one signal. But it's hard to see the one signal when you're getting 13 signals a day or 50 signals a month. It's hard to get that. But as you can see here on the top part of the screen, you have the 10-year German yield breaking down to new, fresh lifetime lows. That's negative, guys. This is not a banana republic. This is a yield that represents the largest economic bloc on the planet, and it just made new lifetime lows. And then lastly, I want to show you the Japanese yield, which doesn't look as scary as the German yield, but still, look at this. On the top part of the screen is the 10-year Japanese yield. Now, it has not yet broken to new lifetime lows, but everything below this black line is negative. So again, you have the Japanese yield market, the third largest yield market in the world, the fourth largest economy in the world, and it's racing to hit new lifetime lows. And again, on the bottom part of the chart, you have the S&P 500 with dividends reinvested via the ticker symbol IVV. People are literally not prepared for the market to scream higher, move higher. Guys, I don't know how much longer it will move higher. We don't get to choose that. Now, we know on July 1st of this year, the US will enter its longest economic expansion in its 244-year history. Guys, that's pretty amazing. The GDP is still at about 2% a year. And basically, anyone who wants a job, actually, let me just take the word basically out. Anyone who wants a job in the United States has a job. Unemployment is 0. Now, officially, it's 3.6%, but that's kind of a weird or dysfunctional number because if you want a job, you've got a job, which means unemployment is 0. We have 0 unemployment in the US. I'm using the RC definition here of 0 unemployment. We have 0 unemployment in this country. We have extremely stable pricing. And the Fed is saying, hey, we may lower rates some more. Now, partially, I believe why they're doing that is because I just showed you the German yield, and on the screen here is the Japanese yield, and they're negative. They are negative. The world is racing to an entire negative 10-year. Now, not every 10-year yield around the planet is negative, but you have the largest economic bloc on the planet, the Eurozone, negative. And you have the 4th largest, which is Japan's economic bloc on the planet, negative. 2nd largest economic bloc, US, 3rd, China. People are panicking. They're selling their equities and they're buying their fixed income. That's what we see here. But the thing is, guys, we could have 2 more years of economic expansion. We could have 17 more years of economic expansion. Investing is not physics, right? This isn't gravity. Now, I'm using those crazy numbers, 17 years, just to prove a point. We don't get to choose how long this economic expansion lasts, right? If the Fed, which has basically made borrowing money free, if they make it even freer, right? Pretty likely that when we do go into a recession, the federal funds rate will drop to 0 and probably negative. This is truly a time where you can thrive, where your money can really grow, like in your grandma's garden, like the weeds in your grandma's garden, like your money can really grow. The thing is, you gotta dump the head trash. You've gotta dump the head trash, and you've gotta either A, join a tribe that believes in a powerfully simple signal, also who believes in immediately stopping their diversification, but believes in this powerfully simple signal, or you literally get your brain trained. You literally rewire your brain so it knows how to thrive in these periods. That's what's coming our way, is a period where huge economic explosions going to happen for a very few people, but it will happen for a few because they're watching the right signal. They're listening. And so what I wanted to share with you most this week was the yield markets around the world, literally the US yield market, the German yield market, and the Japanese yield market. And they're saying the world is panicking, and yet I believe it's panicking because it's not paying attention as we have the S&P 500 breaking out to new lifetime highs. But again, guys, the key here is not more. It's actually less. Join an investment tribe that believes in that powerfully simple signal, that one that knows the difference between a crash and a correction, that can literally filter the noise and give you that great night's sleep. Hey guys, this is RC Peck, and this is just another step in helping you protect your portfolio and your future. Until next time, take care.